Why markets fear a vote more than a missile. On June 24, 2016, the UK voted to leave the European Union. In the opening minutes of trading, the FTSE plunged, the pound crashed to a 31-year low, and economic uncertainty spiked to levels higher than the 2008 financial crisis and 9/11 combined. The trigger? Not a war, not a disaster. It was a vote. This isn't a fluke. It's a fundamental truth of modern finance, and it reveals a deep-seated fear: why markets are often more terrified of a ballot box than a battlefield. It seems backwards, right? Wars destroy, elections build. But to an investor, the risks are completely different. A war, for all its horror, is often an event with sector-specific impacts. When Russia invaded Ukraine, defense stocks like Germany's Rheinmetall soared, and energy giants like Shell saw record profits. But airlines were hammered by airspace closures, and consumer brands faced soaring costs. It's a risk you can analyze and hedge. It's what investors call idiosyncratic risk. But an election? An election is about something far more fundamental. It's not about one event. It's about changing the entire set of rules for the next 4 or 5 years. This is systemic risk. The uncertainty over future tax rates, government spending, and trade tariffs affects every single company. You can't diversify away from a change in the corporate tax rate. You can't hedge against a complete overhaul of environmental policy. This isn't just theory. Studies show that systemic risk, the kind that shakes the whole market, jumps significantly in an election year, and volatility can double during election week. The closer the election and the more different the candidates are, the bigger the fear. And in our modern world, this fear is put on steroids by the echo chamber effect. Social media algorithms and polarized news channels are designed to keep us engaged, often by feeding us emotionally charged content that confirms what we already believe. For investors, this creates a feedback loop of anxiety. Negative headlines about the economy or a political candidate get amplified, leading to overreactions and driving up volatility before a single vote is even cast. This uncertainty paralyzes the real economy. If you're a CEO, why would you spend $1 billion on a new factory when the government that takes power in 6 months might slap a new tax on it or change the trade rules that make it profitable? You don't. You wait. This is called investment irreversibility. And when companies across the country pause hiring and spending, the economy slows down. Data shows corporate investment drops by almost 5% in U.S. election years. That slowdown gets priced into the market. At its heart, this is about human psychology. We are wired to fear the unknown more than a known danger. This is called ambiguity aversion. We'd rather play a game with bad odds than a game where we don't know the odds at all. A war is a terrible but often quantifiable risk. An election, with its unquantifiable impact on the entire economic system, is pure ambiguity. And markets will always punish ambiguity with volatility and fear. So the next time you see markets shaking in the run-up to an election, remember what they truly fear. It's not always the candidates themselves. It's the terrifying, unquantifiable possibility that the fundamental rules of the economic game are about to be rewritten. A fear amplified by the media we consume every day. And in the world of finance, nothing is scarier than not knowing the rules.